Hello and welcome. We are now ready to begin today's webinar, Employee Ownership for Business Succession. My name is Bethany Dennis. I'm with the Rutgers, New Jersey, New York Center for Employee Ownership, and I'll be your host and moderator. Next slide. Today's webinar will discuss employee stock ownership plans, also called ESOPs, which are a highly tax-favored and flexible way for business owners to provide for ownership transition. Participants will learn how an ESOP can preserve business legacy, help to get the seller a fair price, and allow owners to play whatever ongoing role they choose in the company. Next slide. The webinar is scheduled for 30 minutes with question and answer at the end. Participants are all muted, so please submit your questions via the GoToWebinar questions box, and then we will answer them at the end. This webinar is being recorded, and a link to the presentation will be sent to you via email. Next slide. Now it is my pleasure to introduce our speaker. Corey Rosen is the founder and senior staff member of the National Center for Employee Ownership. He has co-authored, along with John Case and Martin Staubis, Equity: Why Employee Ownership is Good for Business, published by Harvard Business School Press in 2005. Over the years, he has written, edited, or contributed to dozens of books, articles, and research papers on employee ownership. He is generally regarded as the leading expert on employee ownership in the world and has appeared on numerous national radio and television news programs. He serves on a number of ESOP company boards in addition to his duties at the center. Rosen received his PhD in political science from Cornell University in 1973, after which he taught politics at Ripon College in Wisconsin before being named an American Political Science Association Congressional Fellow in 1975. He worked on Capitol Hill for the next 5 years, where he helped initiate and draft legislation on ESOPs and employee ownership. And then in 1981, he formed the NCEO. We are very happy to have him join us. Corey, over to you.
Thank you, Bethany. I really appreciate the opportunity to talk to everyone. One thing that would help me out is if in the chat area you could type in what you're looking for here. Why are you at this webinar? What do you hope to learn? So I can try to make sure that I tailor this as best as possible to what your needs are, rather than what I'm guessing your needs are. And it's really important that we get questions. I'm going to go through a lot of material in a short time. And the most useful thing really is after I've gone through that material for you to talk about the specific questions that you have. And remember that any question you have is likely to be a question that other people have as well. So please do ask them. So we're going to cover what an ESOP is. A lot of the focus is going to be used on using an ESOP for business continuity. So what are the tax and planning benefits of selling to an ESOP? What are the rules if you set one of these things up? How are the shares valued so you know what you're going to get paid? And how do you determine whether this makes sense for you? There are about 7,000 ESOPs in the United States. They cover 14 million participants, and they have about $1.2 trillion in assets. You can see on the slide some of the things that they're used for, but we're going to really focus today on the issue of using ESOPs for business succession, which probably accounts for about 70 to 80% of the ESOPs in closely held companies, which in turn account for about 90% of all ESOPs. So it's important to avoid some myths about ESOPs. For instance, a thing that you'll see very often is that these things are too complex, they cost too much money, they are expensive, they are complicated. Selling your business is expensive and complicated no matter how you do it. So the issue is not so much what's more complicated as what's more valuable. Employees must end up with control, people say. That's just not true. They're only for C corporations. They're for C or S corporations. They're really only best for certain kinds of businesses. In fact, they can be found in every industry in the country. And I've heard ESOPs really don't work very well. You'll see lots of data on this, but the default rate on ESOP loans is under 0.5%. That's 2 per thousand per year who we see actually defaulting on a question, on a loan. So why would you want to do an ESOP? And again, the most common reason is for owners of closely held companies to provide for ownership transition in a tax-effective and flexible manner. So if you redeem stock in a normal redemption transaction, that's done with after-tax dollars. With an ESOP, the company can use pre-tax dollars to buy its own shares. That's a huge difference. It allows the employees to become owners without, excuse me, without having to spend their own money, sort of the magic that we'll describe when we talk about their structure. ESOPs are really flexible. They can buy some of the stock or all of the stock from one owner or more. That's something that you can't do in a normal business transition process. Normally, you're going to have to sell the whole company. Nobody wants a minority or partial interest in all but the most highly successful companies. Properly structured ESOPs, the data show, can improve competitiveness, productivity, profits, growth. And if you're an S corporation or become one subsequent to the sale to the ESOP, you can actually avoid taxation on the profits attributable to the ESOP. So 100% ESOP companies don't pay any tax. And that's not a loophole, that's the law. So some of the basics, and we'll detail these later. ESOPs are a defined contribution plan under the Employee Retirement Income Security Act. That's the same law that governs 401k plans, pension plans, and so on. They are company sponsored and company paid for. It is very rare for employees to buy stock. They're funded instead by company contributions to an ESOP trust. The contributions are allocated amongst all the participants in the plan based on their relative pay or a more level formula, and all full-time employees who've worked for at least a year have to be in the plan. And then once they leave, they're paid out the value of their shares on fairly flexible terms. So a lot of owners, of course, traditionally would want their kids to take over. As this cartoon suggests, that's not always possible. Other owners have the option to sell to a private equity group or sell to a competitor, but realize that when you do that, you're going to give up the legacy that you've worked so hard to build for your company. The new buyer may not keep all of your employees. They may move you to some other location. If you want to stay on in some capacity post-sale, the new buyer may not agree with that idea. So a lot of business owners we find today, one of the things they find most attractive about ESOPs is they can continue to work on whatever basis and schedule they want until they're truly ready to retire. So just a brief outline of how this works, and we'll go into the details. The company sets up an employee benefit trust. It then contributes cash to the trust to buy shares, or more commonly, the trust can borrow money to buy a big block of shares, or indeed to buy 100% of the shares. Again, the employees don't buy the stock, and the contributions used to purchase the shares are tax deductible up to 25% of the eligible pay of people in the plan. So a big question, of course, is how much is this ESOP going to pay me? Maybe I've been given what seem to be offers from other companies, and or I have some idea from colleagues of mine what this company might be worth. And for many owners, the calculation is I don't necessarily need to get the very highest possible value, but after all the tax issues settle, I'd at least like to be reasonably close in the ballpark. I don't want to give up a large amount to sell to an ESOP. So the price is going to be determined by an independent outside appraisal firm. And this firm is going to determine what a hypothetical financial buyer would pay for your company, not a synergistic buyer. There are some companies that have synergistic buyers who will come in and say, well, your earnings are $2 million a year, but if you and we combined, your earnings could effectively be 2.5 million, or you could add another 500,000 to our earnings in addition to the earnings that you already have. So we're willing to pay more money for that. But a financial buyer can't create those synergies. And the ESOP is a financial buyer. So the calculation is run on that basis. If you're buying less than control, then the value of those shares is, of course, going to be valued at less per share than if you were buying a control interest. Typically, when you see the valuation done, there are three elements of valuation. The most important by far is a multiple of future free cash flow or discounted future cash flow over an appropriate number of years. So in the first model, called a capitalization of earnings, the appraiser determines that the best predictor of your future earnings are your past earnings. So they project those out into the future. In some companies, your forecast is a better predictor, so they'll rely more on that. Well, now they ask the question, gee, if I'm a hypothetical buyer and this company is projected to make $1 million next year and $1.1 million the year after and $1.3 million the year after that and so on, what would I pay today for the present value of those cumulative earnings? And if you're interested, I can get into the details of how that calculation is created. It's called a weighted average cost of capital. But basically, the theory behind that is, given the risk of investing in this kind of business, in this industry, with these prospects and my alternative investment opportunities, what rate of return would I want? If I want a 5 times earnings, then I want a 20% rate of return. So we see companies in ESOPs typically valued at about 4 to 8 times earnings, but there's a range. They'll also look at to see if there are comparable company sale data or if there are public company data that are useful in creating a different model to say, well, how much did companies like yours sell for? Or what's the multiple of earnings being paid in comparable public companies? The trick with this method is that many closely held companies don't have good comparables. So the weighting on this varies depending on the availability of that data. And finally, a handful of companies are valued at least in part and some entirely on the basis of their assets. But for most companies, the value, if you're only worth the value of your assets, you're worth more dead than alive. So that comes up with a number for the entire company. And then you have to determine, is it a controlling interest or a non-controlling interest? How liquid are these shares? So there'll be some discounts applied to that. And that'll give you the number. What ESOP experts tell us and what companies have told us is that the price that results from all of this is typically, particularly after taxes, in the range of or better than what they think they could have gotten if they sold to someone else. So distinct minority of cases where there's a truly synergistic buyer could offer a price large enough to overcome the tax benefits of an ESOP. So what are those? Well, if the ESOP owns more than 30% of the company, and it's a C corporation at the time of sale, the seller can defer tax on the gain by reinvesting in stocks and bonds of U.S. operating companies. So that's a pretty good opportunity to defer those capital gains taxes potentially for many years. And if they go into your estate, there'd be no tax. If you're an S corporation, this deferral isn't possible, but there are other benefits we'll talk about. As I said, ESOPs can buy some stock now, some later. It's all in pre-tax dollars, and the owner can stay on in whatever role. So let's look at this tax deferral. What are the rules? Well, you have to have held the stock for 3 years. You either have to be a C corporation or you have to convert to a C corporation at the time of the sale. You have to own 30% of the stock as calculated by that bullet there. And if you have family members or 25% owners, they're not going to be able to participate in the allocation of the shares that come as a result of this deferral. And there's a term, the qualified replacement property. So you can invest in stocks and bonds of US companies that make most of their money from operating income, not from, say, mutual funds or finance operations or so on. When you sell these securities, it's a capital gains taxed on your original basis. If you don't take this opportunity, then the sale is taxed as a capital gain, not ordinary income. So what if you're an S corporation or you become an S corporation subsequent to selling to an ESOP? Well, the profits attributable to the ESOP aren't subject to federal and almost invariably state income tax. So if you're a 30% ESOP with $1 million in taxes, then $300,000 of that is not taxable. Now, the 70% owner is going to say, well, I have to pay tax on my 70%, so pay me a distribution so I can pay that tax. And the law says that you then have to make a pro rata distribution to the ESOP, even though it's not paying the tax. So if in that scenario, you're giving out, let's say, $300,000 to there's $300,000 in income that's altogether attributable to distributions, and 70% of that goes to the owner who needs it to pay his $210,000 tax. The ESOP gets $90,000. It can then use that $90,000 to buy more shares, for instance. So in effect, you're using the money that would have been paid in taxes to buy shares. So in that sense, it's a free way to sell your shares. So how do you fund these things? Again, we said it's not the employees who are doing this, and I say that frequently in these presentations because it's something that people have a hard time getting out of their head. So let's look at what the finance procedure is, and this is where we're going to start with the most common way, which is a loan. So let's say that you want to borrow enough money to buy 30% of the company, so you can get that 1042 treatment. And you've got reasonable assets and a solid balance sheet, so you go to a bank and you say, loan the $1 million to us. We will take the $1 million and reloan it to the ESOP. There are technical reasons we don't need to go into now why it's done that way. We'll reloan the $1 million to the ESOP, and the ESOP will buy $1 million in shares. Well, now the ESOP has to pay back the $1 million. Where does it get the money? And the answer is each year the company will make a contribution to the ESOP equal to that year's loan payment. And that's a tax deduction. So you're using pre-tax money to buy the shares out. Now, sometimes you want to buy a bigger chunk than the bank will finance, or maybe you just don't want to involve the bank. So in a lot of ESOP transactions, we see the seller take a note. And this can be for all or part of the transaction. And the way that works is that the seller will agree with the ESOP trust that the ESOP trust will pay the seller a certain amount per year plus interest. There are some fancier ways to structure that payment with things like warrants that can give you actually some equity upside if the company does well. But the seller is going to get a payment from the ESOP, and that again is financed by the company putting money into the ESOP to pay off that seller note. The seller notes are typically, if it's a straight interest deal, running about 6 to 9%. So it's a pretty reasonable rate of interest that the ESOP can pay on that. Now, some companies want to take a more gradual approach, And so they just contribute cash each year to the plan, either to buy shares that year, or they can build a reserve and make a larger purchase later on, maybe in combination with the debt. In very limited circumstances, you could move money from other retirement plans, but we don't recommend that except in the most special cases. So you can see more on the seller financed note here. So what happens in this leveraged ESOP when the company has borrowed the money? So the company has borrowed the money and the shares got purchased, and shares got purchased all in a block, right? But they haven't been paid for yet. So what happens is they go into a suspense account. And each year, as the company makes a loan payment to the ESOP, then the shares that were paid for by that loan get released to employee accounts until they're fully allocated. So this slide shows the flow reviewed. So you sell some or all of your shares. The transaction usually involves a loan, sometimes with seller financing. And as the loan is repaid, the shares become available to allocate to employee accounts. And that's done on a non-discriminatory basis that we will describe. So just some key points. The company funds the plan. The acquisition of the shares is a non-productive expense, so the company has to have enough earnings to afford it. And ESOPs are the only way a company can use pre-tax dollars to buy out an owner. Now, there are some limits on how much you can contribute to an ESOP each year that are described in this slide. To be honest, it's been a long time since I have seen a company that found these limits a problem. If you're interested, I can go through the various ways that you can make sure you stay under these compensation limits. But as I said, it's been years since I've encountered a company that couldn't do an ESOP because of those limits. So something you need to know about but not worry about. Now, what you do need to know and maybe worry about is, well, who gets to be in this plan? Because for some people we talk to, they say, well, I really like the tax benefits of the ESOP, but I'm just not comfortable with the idea of everybody who meets these rules being an owner. I really want to give ownership just to this person or that person or this group of people. And ESOPs cannot accommodate that. So the rules say that employees have individual accounts. The company contributes cash to buy the stock or has the plan borrow shares. All employees who've worked for at least 1,000 hours on a full-time, that's a full-time employee, over the course of the year must be included in the plan. They get allocations based on their relative pay or a more level formula. That cannot be discretionary, cannot be merit-based. And then their account value vests over not more than 6 years. So it has to start vesting after the second year at 20% a year and then become fully vested at 100%, but you can also vest people faster. Now the employees left and they've got a nice chunk of stock, hopefully, and it's time to get their money. And there's a lot of flexibility here. Employees will get the distribution not later than 1 year after death, disability, or retirement, or 5 years after the end of the plan year for other terminations. But you can pay out that distribution in installments, equal installments with interest of up to 5 years. People who've been in the plan for 10 years or more and are over 55 can diversify part of what's in their stock account. So the company makes sure that the employees get fair market value for this stock. The company can put cash into the plan to handle repurchase, or the company can buy the stock back with cash at the company level. The employees have a put right for the shares, meaning once they get the shares, you got to buy them back. And the distributions to the employees are taxed in the same favorable way as distributions from, say, 401k plans are taxed. The governance issue, that's one that concerns some people, but in fact, the voting rights for ESOPs are very limited and almost never become an issue. The plans are governed instead by a trustee appointed by the board. Trustee can be someone internal or external. Anytime you're doing a transaction between the ESOP trust and the seller, however, we highly recommend that you get an independent outside trustee who will vet the process appropriately. And that trustee in turn elects the board, because the trustee is the shareholder. So it's a very circular process. The board appoints the trustee elects the board. And often there's an ESOP committee in-house to assist in the process of overseeing the trustee and making decisions. The costs typically are $80,000 and up, and it can be way up depending on the size and complexity of the transaction. I'd say the typical range is between $100,000 and $200,000. Ongoing costs I've seen as low as $15,000. The bigger the company, if there are changes in laws, other factors, is going to push those costs up. For most companies of, say, 50 to a few hundred employees, it's going to be in the low 20s to maybe as much as $50,000 a year. ESOPs are more expensive than other kinds of plans, but they're a lot less expensive than selling a business in other ways. So if you sell to a competitor, and I've been on a board that went through a sale of a company, it's an enormously complicated, detailed, time-consuming, expensive process with all kinds of financial advisors and lawyers, and it takes a long time, and it usually comes with contingencies. So it's very rare for a company simply to say, we want to buy your company, here's a check. It's much more common to say, here's a check for this part, and we'll pay you this additional amount over time based on some formula that we create. So yes, it's more expensive than setting up a 401k plan, but everybody that I know in M&A tells me that it's actually less expensive and complex, in most cases at least, than selling your business to someone else. So that's a kind of whirlwind tour through the world of ESOPs. Before we go on to questions, let me just comment briefly on whether these things actually work. And there are now lots of data, and a lot of that is thanks to the great work of the folks at Rutgers, Joe Blasi and Doug Cruz and others at Rutgers who've really taken a leadership position in doing this research. But what we know from all these data and all these studies is that ESOP companies in general outperform expectations based on how they were doing before. So the question is, yeah, sure, you've got an ESOP, and maybe you were a company that was outperforming your competitors before. So the fact that you outcompete your competitors after an ESOP isn't attributable to the ESOP. It's attributable to the fact that you're a good company, and good companies are more likely to set up ESOPs. So there's no causality there. So what we do in these studies is we say, well, how are the companies doing relative to their competition before the ESOP? And how are they doing relative to the competition post-ESOP? And what we find is that the ESOP companies improve their relative performance by about 2.5% per year in sales, employment, and productivity. I mentioned that ESOP companies have an extraordinarily low bankruptcy rate, which is a good proxy for failure. And they default almost never on their loans. So those are good indicators. What about from the employee's standpoint? ESOPs provide about 2.2 times their retirement assets compared to employees who are in other retirement plans but about half the workforce isn't in any retirement plan at all. So the median value of their retirement plans in the US is 0. So it's a good deal for employees as well. So overall, it's been very successful. It is not right for every company. Your company has to be profitable enough to take on this additional non-productive expense. You have to be comfortable with the rules. You have to be able to absorb the costs of setting up the ESOP. You will need to spend more time internally, both on the operation of the plan. And if you're going to make these plans work, you really need to create a kind of high involvement, high engagement culture that can get you to the goal of getting more ideas from more people. So the real secret sauce of ESOPs is that an employee-owned company that works well is one where employees, partly because they're owners and partly because of the structure of the corporate culture, are interested, eager, and ready to contribute ideas and identify problems to help the company move forward. And it's those companies who really end up succeeding with ESOPs. So that's a half an hour whirlwind tour, and what I really need now are questions.
Thanks so much, Corey. While everybody's thinking about some of the questions that they might want to ask Corey, I'm going to ask some questions that you're frequently asked, and maybe you could respond and give some people time to gather their thoughts and type. Again, type in the questions box. You'll see it. It's already been used so far. All right, so let me give you the first question. If this is such a good idea for business transition, why aren't there more of them?
There are a number of reasons for this, but the most important is informational. When you talk to advisors about ESOPs, a lot of them, people who aren't ESOP experts, say, oh, that can't work, or they heard of some company where it didn't work, or they have some misinformation about how the plans do work, some of the myths that we talked about before. That's the best interpretation. The more insidious interpretation is that for some of these advisors, if I go to my accountant, for instance, say I need some help in doing business transition, I've heard about this ESOP thing. Well, I'm an accountant and I don't know anything about ESOPs. Do I really want to tell you that's a great idea? Let's proceed with that. Or do I want to say, I can help you with that, with what you're comfortable with and knowledgeable about, in helping you find another buyer? Or you go to a business broker, and this gets even dicier. You go to an M&A person or a business broker, they make their money on a success fee. So they get, like a real estate agent, they get some percentage of the transaction. And that's premised on the idea that they can find buyers. Well, that's worth paying for if they're finding you a buyer. But if you're selling to an ESOP, you already found a buyer. So why would you pay somebody to do that? So we've had business brokers tell us, yeah, ESOPs sound like a terrific idea, but they don't sound very much in my interest. So I'm not going to tell people. So those are everybody I think who's involved in this field feels that that's the main problem.
Thank you. Um, Question 2, how do I choose advisors for this, and can I use my own attorney?
Only if your own attorney is specialized in doing this work. This is a very specialized field, and you want to go to the people who are truly experts in the field. So if you go to our website at nco.org, there is a service provider directory. So you can look that up and you'll find lawyers and appraisers and plan administration firms and valuation firms and all the various experts that you need. We're not specifically endorsing those people, but we don't let people into that advisory service unless we have reason to think that they are experienced in this field and that there's no obvious skeletons in their closet. So at least it's a start.
Understood. Somebody typed in a question, Meg Berghausen. If there is a set number of shares available in the ESOP that are distributed to all eligible employees, what happens when you hire additional employees?
Sure, that's a great question. So we want to look really at two stages of this. In the first stage, the ESOP is busily acquiring shares, and most often that's with a loan, but it could be with these annual contributions that are buying shares, and that's going to take a while. So that could take, the way these loans are typically structured, there's a loan to the company that's paid off as soon as the company has the money to do it, but there's a reloan to the ESOP that has a longer term, might be, let's say, 10 years, 15 years, sometimes it can be even longer. So the shares are being allocated over that longer period of time. Similarly, if you're making annual cash contributions, that process may go on for several years or more. So during all that time, the shares are being allocated. But at some point, all the shares have been purchased and allocated. Well, now a couple of things can happen. One is employees are going to be leaving. And when they leave, either the company can buy them back or the ESOP buys them back. And most often what we see, especially in 100% ESOP companies, is that the company will buy back the shares, and then on whatever schedule fits for it, it will recontribute shares to the ESOP. So those shares that are recontributed go to everybody who's in the plan that year. So new employees would get some of those shares. Also, when people leave, if they're not fully vested, their unvested shares are forfeited and they go to everybody who's in the plan. So in some companies, there's enough shares from those two processes to make sure that new employees can get shares. In other companies where this isn't enough, you'll see that companies will make cash contributions to the plan once it's mature. They do that for a variety of reasons. And then if I'm a new employee and I'm all cash, and there's a very senior employee who's all shares, we're going to do transactions within the plan so that every employee ends up at the end of the day with the same percentage of cash and stock. So this issue, which can be a very important one, is mostly a planning issue, not an inevitable problem issue. There are a number of planning tools that you can use to make sure that this does not become a problem. Okay. We've seen there are ESOPs that are now 50 years old.
Wow. Thank you, Corey. Let's do one more question and then we'll end today. It says, what type of financial disclosure is the company required to give the employees?
You're not required to give them any financial disclosure other than an annual statement that says this is how vested you are in this many shares worth this amount of money. Now, that's what you are required to do. The vast majority of ESOP companies find that it is really useful to share at least a high-level view of the income statement and balance sheet, but also even more useful to drill down to metrics for particular operations. So you'll see if you walk around a lot of ESOP companies, they'll have groups talking about or numbers posted on, here's our numbers for this particular operation. How are we doing? How could we do better? So sharing these numbers with people really helps give people a sense of ownership and also gives them the metrics that they need to help move the company forward as owners. You don't have to do it, but as Jack Stack, who's the head of SRC, which is one of the most spectacularly successful, not just ESOPs, but companies in the US, 100% ESOP now, said, if you don't share the numbers, it's like asking people to play a basketball game and not telling them the score. It's not going to be very motivating. And the risk of sharing the numbers is vastly lower than the risk of not sharing the numbers and losing the opportunity for what that can do to improve performance. I have yet to find a company, except one in a very peculiar situation, where its main competitor was across the street and was also 100% ESOP. I've yet to hear of a company that put out information on its financials and then regretted that it did because somebody got it who shouldn't. But you're not required to.
Thank you. That makes sense. All right, that's all the time we have for questions for today. Um, let's see. Oh, actually, no. Robert has one more question. How can this work with the business? All right, I think that's all the time we have for questions today. Robert, I'm going to have Corey follow up with you offline. But if anyone has any other questions afterwards, just feel free to email us and we will get it over to Corey and we will make sure we get a response over to you. Our next slide, Corey, which is just a placeholder. We have not finalized our November webinar as of yet, but we are going to announce it very soon, so please be on the lookout for that. And this concludes today's webinar. As I mentioned earlier, a link to the recording of the presentation is going to be emailed to you. Go to the next slide, Corey, so they can see our contact information. There it is. So for more information on the New Jersey New York Center for Employee Ownership, just visit our website, ownership.rutgers.edu. Thank you so much, Corey, for presenting. We really enjoyed
My
having you.
pleasure. Thank you for having
Thank
me.
you.
And if any of you have questions, contact me.
Yes, absolutely. We'll make sure you put you in touch with Corey. And thank you all for joining us and being here today. Enjoy the rest of your afternoon.
Okay, thanks everybody.
Take care.